Experts expect a market rebound in 2021. Let's have a look. Hello everyone, Florian Heiser here and welcome to another episode of Heiser Says. Grab your stein of coffee because I'd like to have a look at this article from the ABC because experts are predicting a rebound in the share market this year, pinning all hopes as it seems on a vaccine. Now if we jump over here we can see this is the ASX 200. It plunged. It really plunged. Remember when it was under 5,000 in the 4,000 and it steadily climbed right back up again to 6,500. Not quite at the all-time highs that it once was. We'll zoom out to 10 years and you can see. Now the question is, are we just seeing a dead cat bounce and will the market correct down, or is it going to rocket back up? Look at what's happening in the States at the moment, everyone. The market, well, finished close to all-time highs. It was a crazy year with the economy pretty much, well, non-existent or severely restricted. The market seems to be disconnected from the fundamentals and realities. And, well, we've seen that with all the businesses that make absolutely no profit, and yet they're still, going insane. So let's look at this. As the old saying goes, hindsight is 20/20, and it certainly applies to the share market every year. Let's assume you had a time machine and traveled back to January 1 last year to buy shares as part of a retrospective get-rich-quick scheme. Certain stocks might have earned you a truckload of money if you sold them just before last night's New Year's Eve fireworks. These missed opportunities include Marley Spoon, up 980%, Temple & Webster, up 307%, Afterpay, up 303%, Kogan up 150%. All of them benefited from the pandemic shift to online shopping. Given how much they rose, it's unlikely those giants will be replicated this year. ABC News spoke with several market analysts about their thoughts on where the Australian market is headed. Even the least optimistic person was quite optimistic, as they estimated the ASX 200 could lift by about 10 to 13% this year. That's compared to the 1.5% loss the benchmark index sustained in 2020. They based their assumptions on a COVID-19 vaccine being rolled out within months, the government and Reserve Bank pumping more stimulus into the economy, and the hardest hit sectors making a recovery. Here are some of their forecasts for the year ahead, but please remember to also do your own research and obtain independent financial advice. Now here's the thing, are we just going to see a manifestation of the RBA and the government just pumping more money into the economy so that inflation, materializes in the share market? I would suspect most of it will develop in property here in Australia, but that's the Cantillon effect. The Cantillon effect refers to the change in relative prices resulting from a change in money supply. The change in relative prices occurs because the change in money supply has a specific injection point and therefore a specific flow path through the economy. Now we can see this when, the US were handing out money left, right and center, stimulus checks, and people were investing it into the market. You can then see that, increase in money supply into that stock. That's the flow path and it creates a bubble. In Australia, well, a lot of that is manifested in property. That's the problem when the government gives all these handouts and incentives to get into property, or when property is used as the, most common method, I would hazard a guess, to reduce people's taxation. So let's have a look at what Shane Oliver, AMP Capital Chief Economist, is saying. I think that the big story in the year ahead is a lot of the winners from 2020, or more from the pandemic at least, won't do as well as we go into economic recovery. I think the environment we're coming into is the one where cyclical stocks will be the star performance. Banks, industries, mining companies, energy companies, and stocks which at least initially benefited from the pandemic and lockdown, such as healthcare and IT stocks, will probably take a bit of a back seat. Kyle Roeder, IG Markets market analyst. I think our market strength will be led for the first part of the year by bank and energy stocks. Bank stocks still have the capacity to climb as the local economy recovers. The reopening of the global economy ought to lift energy demand and benefit what's generally been an underperforming sector for most of this year. Craig Sidney, Shawn & Partners Senior Investment Advisor. I'm hopeful of a recovery in the banking sector provided bad debts remain subdued. NIM net interest margins remain stable and loan growth shows sign of improvement. Energy should also outperform if global economies reopen and demand for oil and gas improve. NAB, Westpac, Santos, Woodside Petroleum, Telstra, and CIMIC Group were some of the stocks Mr. Sidney said he would watch closely, given they are blue chip stocks which suffered heavy falls last year. So looking to jump into some of the opportunities there, perhaps. Daniel Ura, Sharecliplicity author. Although the rising Australian dollar is a headwind to our economic recovery and those companies that earn US dollars, I think the quality healthcare shares such as CSL, Cochlear and Ramsay will benefit from the rollout of the vaccines. I think shares exposed to the Australian housing market will do well, including Australian Financial Group and Liberty Finance. I remain wary about travel and shares related to international tourism, as I think the virus will continue to be an obstacle to any return to normal in spite of the vaccine rollouts. I would buy Mineral Resources and Fortescue Metals on a pullback in the iron ore price and weakness. There will be some good dividends from iron ore plays. So interesting here, looking at health and resources if there's a pullback in iron ore. So Chris Weston, Pepperstone Head of Research. Mr. Weston is optimistic about cyclical sectors like energy and materials, as inflationary pressures should become more of a consideration as the year progresses. Central bank debasement will remain a continued theme, and if the US dollar continues to trend weaker, then it limits global central banks to do anything other than stay in lockstep with the Federal Reserve, he said. This leads to gold miners as a hedge against the madness in central bank regimes. With dividend income improving, banks should work fairly well in 2021 and should offer benchmark returns. With the Aussie economy growth close to 4% in 2021, we should have greater confidence to hold exposure in this space. So looking at banks and gold mining. So Chris Pedersen, Pedersen Asset Management CEO. Mr. Pedersen is expecting banking stock to recover as the dividend growth rates are looking very attractive. Dividends will start going back to where they were in 2019 if we take the long-term view up to 2024, he said. Iron ore miners have been phenomenally strong lately. Their free cash flow is ridiculously high. I'd continue owning iron ore companies until global supply starts increasing to the point where there is more supply than demand, probably towards the end of 2021. So Junbin Liu, Trebek Investment Partners lead portfolio manager. Tech is expensive. However, in a world where growth is harder to come by, they will hold their value. I'm a believer of buy now, pay later, so we like afterpay. In the next 12 months, we expect it to outperform, combined with some beaten down sectors. Ms. Liu is also expecting property trust shares to recover this year as foot traffic will return to shopping centres. She was also optimistic about private hospitals, including Ramsay Health Care, and premium assets like Sydney Airport, which she expects to lead the returns over the next 12 months. So here we have some interesting, perspectives and, hints and tips, one might say, although, constant reminder to do your own research. So property trusts, because foot traffic is dropping, do you think there will be a return to the potential nice dividends from real estate investment trusts? That's one thing to consider. We've all been locked down. I'm going shopping now, and sure, they're empty shops. I see them boarded up and hidden. But it feels like, particularly here in Queensland, it's just completely normal. At least over Christmas, it was quite busy. So maybe there could be some opportunities there. Ramsay Health Care and Sydney Airport. Sydney Airport significantly cut their CapEx last year. We'll have to see how this moves forward. They're tied to the tourism industry significantly. And then you've got, iron ore miners. Have you got into any of those guys? Have you been holding an iron ore miners getting a nice fat return? If we jump over here, let's have a look at commodities. Gold is at $18.98 US. Silver's $26.40. We scroll down to iron ore. Once we get there, eventually, it's at $158.50 US a ton. So remember, the federal budget is expecting $50 US a ton. So not even on this chart, everyone. There you go. Not back since 2016 were we getting those prices. So I remember back when coal was quite high and we were working on coal mines, and then the price adjusted, so then the quality of the design and the fit out that people were spending on these camps changed quite dramatically, which is quite interesting. So we've got Daniel Ekuri. I probably pronounced that wrong. My apologies. Australian housing market will do well. Well, they're just pumping money to the housing market. And by that, would you consider investing in businesses that are taking advantage from it? Some of the builders, some of the listed building companies that you could go in. And we've got here, Craig, the banking sector and the demand for energy and oil. I mean, banking, it's dividends. You just want the dividends, a lot of people. So we've got energy stocks, banks again. We've got Shane from, banks once again and energy stocks. So what do you think, everyone? Do you think the market will grow again next year? Will we recover? Will the market climb back up to where it once was? We'll have to see. I mean, if they just keep, if stimulus keeps going and money keeps flooding in the market, we're going to see these bubbles manifest. Property or the market. As always, let me know your thoughts and opinions in the comments down below. Please like, share, and subscribe to the channel. What are your investment plans for next year? Let us know. If you're a fan and want to support the content I create here, there are a few ways you can. You can join us on YouTube or Patreon. Support us using our affiliate links at Amazon, eBay, Independent Reserve, or Aussie Broadband. You can buy a merch from Heiser Says, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, everyone, and I'll see you next time. Bye for now.